This will be available as a podcast under the Lead Lag Live banner on all your favorite platforms. With all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Spencer Jakab, editor at the Wall Street Journal, Heard on the Street column. Spencer, I'm super excited for this conversation. I spent a little bit of time listening to some of your prior talks. I think this will be really interesting for the audience. But before we get too deep into things, introduce yourself. Who are you? How'd you get interested in the financial journalism side of the industry, and what are you doing at the Wall Street Journal?
Hey, thanks for having me. Yep, I did not really know anything about journalism or financial journalism when I got out of college. I was on my school paper because it was a girl I liked on the school paper, and wound up going out with her for a year. But that was, I didn't know about journalism as a job. I didn't know about finance as a job, for that matter. And I did a master's program later at Columbia University in International Affairs. Met a kid who's now, almost 60-year-old kid. We're still friends, who had been an investment banker. And I really had never been exposed to that. My parents were refugees. They didn't know about, Wall Street, other than that's a place where you invest. And I asked him what that was, what it meant. He said it was a horrible thing. But then he told me how much money he had made out of college at Bankers Trust. And it piqued my interest because money sounded interesting. And he said I just needed to take all the finance coursework. You were allowed to do it then at Columbia Business School on top of my usual coursework. And I wound up liking it a lot, became an emerging market analyst, worked in finance for 10 years. And then I just got bored with it, and felt that finance was very interesting, but I'd like to be able to call up smart people and talk about it and write about it, and would accept a pay cut for doing that. So I've been a journalist for the last almost 20 years, the last 11 years at the Wall Street Journal, where I edit the Heard on the Street column, which is the financial analysis and commentary part of the paper.
Do you find that wearing the journalist hat is different than wearing the analyst hat? How are the two similar and different?
Well, there are definitely differences. One is that, with all respect to the analyst profession, I mean, you often will miss the forest for the trees as an analyst. You're focused very specifically on maybe a dozen companies. You're tracking changes here or there. It's difficult. There's a career risk in changing your opinion too quickly, which is why you'll see these analysts downgrade a stock after something horrible has happened, or upgrade it after it's had a big run, because because analysts are just not very useful as stock pickers. Analysts are useful in terms of, if they're good analysts and you read their research and you have a lot of nuggets and details in there, and they're good at explaining the business of the companies they're writing about, that's all fine. In terms of target prices and recommendations, those are demonstrably worse than useless. And a journalist, whether it's someone who does specifically what I do, where you're taking a view, or if it's someone who's a purely objective journalist who's pretty smart and knows what kind of questions to ask, I think can be of much more service in terms of you doing your research into what you'd like to invest in or not invest in. Having said that, of course, journalists are not doing the deep dives into companies. I mean, even though Heard on the Street employs some former analysts and brokers and things like that, we don't have a financial model. We're not doing that level of research. And as I hope you all know, there's also diminishing returns to doing a lot of research. That that you've done 10 hours of research on a company, that 11th hour of research is not going to yield much benefit often. You should have found out the important stuff in the first 2 or 3 hours.
Yeah, no, I think that's absolutely valid. Do you get the sense that financial journalism is less apt to bias compared to traditional journalism outside of the realm of investing, that it's less emotional or less agenda driven?
I suppose so. I mean, you can definitely, if you want to name outlets, whether it's cable channels or newspapers, if you read them enough or know them enough, people will, and depending on their point of view, they might say like, no, the New York Times calls it exactly like it is, but then this other newspaper is, I feel, is biased. It really depends on what you consider normal and what you consider, good and rational and whatever. But there is unconscious bias that creeps into journalism, and of course there's an editorial slant. I think that with the kind of honestly there's value in reading any of the sort of the leading newspapers, and then probably your local newspaper, even if you think that it tilts to the left or tilts to the right, because journalists generally are, in the United States especially, less so in other countries, are really, it's drilled into them that they should be objective. They might not achieve it, in your opinion, but they're out there finding things out. That's the main role of journalism. My part of the paper is a smaller part of the paper where we have scoops of insight, but generally, journalists are out there finding out what happened, what this person said. They're looking for scoops of fact. They're looking out for looking for things that haven't been reported. That's useful. Period. There's no bias to that. If you want to filter it through how you can not like the New York Times, but you'll find lots and lots of very useful revelations in the New York Times. You're doing yourself a disservice if just for some ideological reason, you're not reading one or another paper. Now, when we get to cable channels that sort of, MSNBC and Fox News and whatever on the left and the right, respectively, they do a lot less news these days, right? They discovered that this business model works a lot better. You used to have people all over the world. Something was happening in Baghdad or in Moscow or in Paris, and you had a bureau there, and it was expensive to keep up those bureaus and send people around the world and have camera crews and stuff like that. And they figured out that a lot more people will watch your channel if you have people kind of ranting, taking an ideological position. And even though those people are often very well paid, it's way, way cheaper to have a handful of people like that who are sort of, really more ideologues than journalists. And so that's what on TV it's devolved into, but newspapers thankfully have not gone that way.
Yeah, no, that's a fair point. Now, I have to imagine that the last 2-3 years have probably been the craziest from a financial journalism perspective. Talk through the audience how odd it's been, perhaps maybe is the right word, to cover all the things that have gone on, not just post-COVID, but obviously the meme stock mania, which we'll talk about, and then the way things have played out this year. Has there ever been in your career, Spencer, anything even remotely close to the number of insane things that we've all seen in the last several years here?
I guess no, it's crazy. I mean, with crypto and meme stocks and things like that, it's extremely interesting. And and then with COVID and this incredibly rapid panic descent from an all-time high into a bear market, then the fastest recovery ever. I think that financial markets are weirder and more exciting than they've been in a long, long time. I started out working in finance, and I worked in emerging markets. And working in emerging markets, I mean, it's a little bit like dog years. Everything's compressed. So whereas I'm 53 years old. Someone my age who's worked throughout that time in Wall Street, you've seen two really big financial crises. Maybe you were brewing for a third, but you've seen two really big wipeouts in your career. You weren't working yet for the crash of '87 and stuff like that. The 10 years that I worked in emerging markets research, you saw 5 in different parts of the world. So, there was always something just crazy happening, people being wiped out, bank runs and stuff like that. And, that affected the people in those countries in much more extreme ways than your 401k losing half of its value. It's like your savings becoming worthless and stuff like that. So, yeah, so I kind of became not that I like to see bad things happen, but, I get very excited too, when I see crazy stuff happening. And, because it's amazing to be writing the first draft of history as a journalist and trying to figure out what it all means and what's going on.
So to that end, that's I think a good segue into your book, The Revolution That Wasn't, and everything that happened with GameStop. Now, I talked to a lot of individuals, financial advisors, and I'll often share my screen and I'll show to whoever I'm talking to the chart of GameStop, and I'll note that the spike in the price happens, or the Roaring Kitty and all this stuff, the week of, I think it was January 25th. And then within 2 to 3 weeks after that, ARK peaked. Within 2 to 3 weeks of that, emerging markets peaked. Within 2 to 3 weeks of that, small caps started going sideways, breadth started deteriorating. And I've often made the argument that the bear market really started February of 2021, because that's when the vast majority of things started rolling over, even though large cap S&P kept on pushing higher in what looked like a bull market. Walk us through as it was unfolding from a financial journalism perspective, what you perceived as what was really happening when it came to the initial GameStop spike, and then just talk through sort of the way that evolved over time relative to the broader market.
Well, I think you're right that, and I don't think that it's a coincidence that it happened shortly before the peak and all those things. But and we can get back to this, but I think cause and effect are a little bit different because my book isn't just about the crazy story about what happened with GameStop and all these, traders organized on Reddit and these hedge funds getting wiped out or almost wiped out, which is a crazy story in itself. But I tell how it happened, what the build up to it was, and the build up, the crazier the build up, the harder the sell off, and the bigger the come up. And so we're not done with it yet. By the way, I don't think that we've seen a true moment of capitulation. Maybe we have. Obviously, there are people who have thrown in the towel, who lost a lot of money individually, or have kind of seen the light, or have become much more conservative investors in the last year and a half or so. But I don't think that we've seen the ultimate wipeout. I think it's an unfolding process. But so, what did I see? I mentioned before that journalists write the first draft of history, and unfortunately, the first draft is often a little rough. And the whole thing was brought to my attention. I have three sons. My eldest boy is now out of college. He was senior in college at the time. He was home. There was a week where he normally wouldn't be home, but I guess the semester was delayed because of COVID. And he came over to me and he said, "Hey, Dad, are you going to write something about GameStop?" And like GameStop is like a place I've driven him about 1,000 times, in his life. I mean, and so I took a look at GameStop. Was a company I'd edited a lot of columns about GameStop over the years, but fewer and fewer because GameStop was this tiny retailer expected to go out of business. I think when Heard on the Street wrote about GameStop, it was just to get a view into the larger world of video games, to get some our finger on the pulse, rather than GameStop as a business. It was tiny. I think it had in the spring of 2020, it was worth barely $200 million. But he pointed it out to me, and took a look, and it had doubled in the last couple of days. And I asked him why. He asked me about it. He said because a friend of his had bought the stock and it doubled. And so I saw that they were talking about it on Wall Street Bets. I've been aware of Wall Street Bets for a while at that point. But it was just a joke in the Wall Street Journal newsroom. We'd see something go up, and like you knew that it was just like this flash in the pan. And and then after a few days or a few weeks, the air would come out of it, and that was that. But something he said to me made me sit up, which was that I said, "Your friend should probably sell. Like it's you don't know how much more this is going to go up." He said, "No, he won't sell. He can't sell. He's got to have diamond hands." And so I started reading the board, and at that point, I had a 3/4 written book proposal I wasn't too excited about that I was going to send to a publisher, and I forgot about that immediately. I said, "This is amazing. This is the a stock market corner being organized out in the open, where you have several 100,000 people, completely legally, basically. It's illegal to corner someone in the stock market these days, since securities laws have existed, but this was something totally new." And I wrote a note to the acquisitions editor at Penguin Random House, and they were intrigued, but they the first articles hadn't begun to appear about it. I said, "No, I haven't heard about that. Do you have a proposal?" And it's like, "No, this is happening now. It's going to be a really big story." So my initial excitement, I kind of missed it took me a couple of days to see the broader significance of the story, I have to say. So by the time I sent them a proposal, which was about 48 hours later after pulling two almost all-nighters, then I saw the story for what it was, which is a bigger deal than just a crazy event in the stock market.
What was the real lead up to it? I mean, is it as simple as, there was all the stimulus, people were at home, people were bored? It seems to me that that's a little bit too simple of an explanation, that there was probably something maybe building beneath the surface, and all it needed was a catalyst to all come out.
Yeah, you had several things. It was really a perfect storm. So one thing is, think about the generation. As there are people who are older, there are women, but it was the cohort that played the biggest role in this was males between the ages of 18 and 35 who had been too young for the most part to actually have any negative consequences from the financial crisis of '07 to '09, but it was the formative financial experience of their lives. So they knew that Wall Street was bad, that hedge fund managers were the worst people on Wall Street, and They might not have known what short selling was. They still might not totally understand what short selling is, but to them, someone who was selling a stock short, there's always been a bias against short sellers in the stock market. They're seen as kind of rapacious vultures who are betting against what most of us want to happen, which is stock prices going up. So someone who was a short seller on Wall Street at a hedge fund, and then who was betting against GameStop, which is this thing that, like, for my sons and people older than them, was like a central part of their childhood. How could you be more evil than that? So it was like a perfect kind of cartoon villain in their mind. So that was one thing. That was the setup. And this was a generation where it wasn't very cool to be in finance, but you had more than 10 million retail accounts opened primarily by young people in the 12 months leading up to this. And you had a few different things. First of all, you had Robinhood itself. Robinhood, during the 5-year period leading up to this, opened one of every 2 brokerage accounts in the United States, although it still was a very small broker because the size of those brokerage accounts was tiny. It was like the kind of accounts that Fidelity didn't really want to deal with. And the reason it could do that was the sort of, this great, alluring, gamified app that it had that drew people in, where they were going back and checking their Robinhood accounts on average 7 times a day, which is crazy. But then in late 2019, every other broker threw in the towel and went to zero. And they thought that it would hurt their business. And what they didn't understand was that when you take something, if you take something that's utilitarian and you cut its price, then people might consume a bit more of it. But if you take something that's fun and you cut its price to zero, even if it costs very little, if you cut its price to zero, then people are going to go crazy and consume a lot of it. And stock trading turned into a really fun game, especially for young people. If you're my age and you have COVID lockdowns and you didn't know how bad it was going to be. You have COVID lockdowns and you see your retirement savings, you're maybe 10, 15 years away from retiring, and those carefully built up savings, fall by a third. You're pretty upset. That's really what you're thinking about. You're not saying this is great, this is exciting. But if you're young and you really have no savings and you've just opened a brokerage account because your friend, got a free share of stock for, getting you to open your Robinhood account, and you got a free, like kind of sweepstakes kind of thing, like a mystery share of stock, you're pretty excited. And you don't care if stocks are going up or down. You just see they're bouncing around. And in the year leading up to the meme stock squeeze, almost, it was like an amazing money making opportunity and a lot of fun for these people because stocks were bouncing around like crazy. And the lesson that they learned, it was the wrong lesson, but the lesson they learned is that, like, you don't want to listen to not just like your dad's stockbroker, but you don't want to listen to Warren Buffett or someone like that, because look, that fool sold all of his airline stocks when just before they bounced back and jumped 70%. So the old sober voices were no fun to listen to, and that's not where people went to get their financial advice. They went to they crowdsourced it from places like Reddit and TikTok and what have you, and these finfluencers. And those influencers, whatever the sorts of stocks, even like bankrupt companies like Hertz, just dumb stuff to buy, was doing well, when people like me at the Wall Street Journal were like, no, stop, don't do that. That it's a bankrupt company, it has no value. Now, Hertz wound up actually having some value in the end, so turned out okay, I guess, if you held on. But that was the way to make money. And so the kind of the dumber the thing was that you bought, the better you did. And in that 1-year period, 96% of American stocks from that bear market bottom rose. So there's never been a period where it was like shooting fish in a barrel. It was very difficult to lose money.
And it almost created, I think, almost like a feeling or a cultural generational warfare almost, right? You started having language like "okay, boomer," right? Whenever somebody would try and counter some of that, which I think is fascinating, because what the point about there's the memory of '08, and that's sort of the generation, that's the response to that, I think, is intriguing, right? That you can maybe attribute some of this to that memory from the great financial crisis. But I guess it's amazing to me the way that the narrative seems to be most focused on the gamification that caused this, right? So you alluded to it. Robinhood obviously was a big aspect of this, but do you get the sense that even if Robinhood were not around, even if gamification were not as prevalent, that you'd have a similar type of dynamic, or was that a necessary ingredient to cause this kind of insanity that we saw?
Yeah, I think it was a necessary part. I think you wouldn't have had the same surge in speculation. So I think if you look at Wall Street Bets and Robinhood, there is a symbiosis there for sure in terms of having this really, really frictionless app that was totally intuitive to particularly to a generation that had grown up with smartphones. And then having on the same device, being able to scroll between a place where you're getting crazy financial advice and having this app where it doesn't cost anything. It does cost something, of course, as we know, but in your mind it doesn't cost anything. You're just trading in and out. You can buy a fraction of a share. You can do it with very little money. So there's not that like, hey, let's stop and think for a second. There's not that little speed bump, at all. It is completely frictionless, and the device where you hang out all day, and especially you were hanging out on it even more during the pandemic when you were at home a lot and bored, and this thing where that you can manage your finances, your little pool of capital. It was a perfect setup. So, but the thing that I really only started to understand as I was writing the book, and I kind of better understand now that it's come out, is that there's this real nihilism to this whole thing, where so you can't, this group is not a monolith. Okay, so if you have been involved ever in your life with like a political movement or a campaign or a religious organization or something like that, you know that like the people who get to it late are the most earnest, right? So you had people jumping on the bandwagon. You had the membership of Wall Street Bets go from like 1.1 million at the mid January 2021 to like 11 million by the end of the next month. So a lot of those people who jumped on the bandwagon opened accounts and were very very kind of vocal about this and wanted to stick it to the man were not the original people who were sort of looking for an edge or looking for a hack. I think the original ethos of Wall Street Bets was looking for a hack, looking for a way to kind of trick Wall Street and make a quick buck, and or do something dumb and show everyone the kind of jackass style, like the dumb thing that you did. So there's a lot of kind of quote unquote loss porn on it too. But there's this real nihilistic sort of sense that like I don't care if I lose money. I want to. What matters to me is that Gabe Plotkin lost money. I want him to lose money. I don't care
It's
if I
almost like revenge trading, right? It's sort of like, I want to trade just to get to somebody else, not because I want to gain from it.
Right. And there's nothing that's something that I've never ever seen. So that's something that is really something unique. I mean, this whole thing was crazy, but that is a unique aspect to it. People had never weaponized their brokerage accounts before. And yeah, and it I think it's a minority of the people who are involved in this for sure, but very active minority. And what we learned from this and what we've learned since is that a small group of people can really it's not that hard. It doesn't take that much to weaponize it. If you're trading a small stock like AMC or GameStop or something, and you're like, hey, you can do a gamma squeeze. You can basically buy, out of the money call options that expire pretty soon, and have basically, if enough people do it all at once, it's a self-fulfilling prophecy. You can actually make the stock go up for a while. It's not like a money-making scheme. Like you're still burning up a lot of premium and you're still enriching brokers and stuff like that, and you're unlikely to make money doing it. But if all you're interested in is making a stock go up a lot in a short amount of time, then they discovered ways to do it, especially with these thinly traded stocks. It's not going to work with Apple, but it works really well with AMC or GameStop.
There was also a sort of, I think, conspiratorial mindset around a lot of this stuff that I remember seeing often in terms of why this or that stock would move and why it wasn't moving because some other entity or individual was making sure it wasn't moving. Have you ever seen anything from that perspective as pervasive as what we saw? I mean, there's always a degree of conspiracy theorists out there, and admittedly, some of the conspiracy theories may end up ultimately being true or are true. But
Right.
that sort of collective mindset around this conspiracy aspect to meme stocks, I think, was also really fascinating.
Yeah, I mean, I hate to be dismissive of people. I'm a financial journalist. I want people to be well informed, not to believe in conspiracies. But yeah, it's like it's cuckoo crazy stuff out there. There are all kinds of, that's the thing, is like a little knowledge is a dangerous thing. There's information out there. Having information is not the same thing as having wisdom, right? There's a lot of information out there that someone will look at and then put on Reddit and then misinterpret it and say, so you see, this means that hedge funds are manipulating this thing and they're still in, and there are millions of phantom shares. And you probably most people, and if you haven't, then go Google it now or after the call. MOASS, the mother of all short squeezes, which is a conspiracy theory that continues to persist and has taken on many permutations, where there's this theory that there's going to be an even bigger short squeeze because there are a whole bunch of synthetic shares that exist in these companies, and the hedge funds the hedge funds don't care. Hedge funds are sort of, this is like, I mean, I'm sure that there are funds obviously that get in and out of these stocks today and sell them short and stuff like that, of course. But big hedge funds are sort of, they've got much bigger fish to fry than worrying about AMC and GameStop. And there are not millions of phantom shares. But like you said, a conspiracy does sometimes have a kernel of truth, like a lot of conspiracy theories do. That's something that people should appreciate, that conspiracies, and sometimes conspiracies are true, right? So, there's like a failure to deliver or something. You're like, aha, there are all these failures to deliver. That means that whatever. No, it doesn't mean that, but it means that there are people who game the system or whatever, or there's sloppiness on prime lending desks, and that short selling isn't maybe as kind of tightly regulated as it could be. I don't think it's a conspiracy. I don't think it's anything that hurts mom and pop investors who are kind of patient and long term. It's kind of a non-issue. But yeah, and then this whole thing about the way payment for order flow, which is another boogeyman. I mean, it's just a way that these dark, it's not dark pools, but basically, I think today there are about 13 to 15 stock exchanges in the US. But then a lot of retail trading doesn't go through a stock exchange. It goes through, a company like Citadel or Susquehanna, or, that basically processes the trade itself in its black box and then pays the brokerage firm that sent, like Robinhood especially, that would make a lot of their money that way. It pays the brokerage firm for sending it the order. And then they see some dark, nefarious conspiracy. Well, I understand pretty well how payment for order flow works. It's not that bad. I mean, you can get rid of it and trades would happen a different way. It wouldn't really change anything. What it did, I mean, the problem that I see with payment for order flow is that it enables the system where you have brokers like Robinhood that are incentivized to have you trade as much as possible. And, there are not a lot of truisms in finance, but one truism is that there's a direct inverse correlation between how active you are and how well you do as an individual trader. I mean, the people who trade the least do the best. The people who trade the most do the worst. And that's not taking costs into account. That's just, activity is anathema to returns.
Let me reset the room for the meeting minutes or so here. Everybody, please make sure you follow Spencer Jakab on Twitter and check out The Revolution That Wasn't, available on Amazon. Again, this will be in a podcast fairly soon. Let's go to some of the audience for a question.
I think that's a great point. So anger, or more specifically resentment, is an important thing to understand today. I think people who feel that they're second class, that they're being left out, that they're being kind of screwed over. I think that, first of all, just economically, this generation, 90% of people, or 95% of people are in this generation, they didn't go to a fancy college. They went to college. Maybe they didn't go to a fancy college. They got stuck with student loans. They don't have a great job. They felt like they were promised something and they didn't quite get it. And there is resentment towards the haves by the and not the have-nots necessarily, but the have-lesses, people who, yeah. And so I think that's something that I think the thing that you identify is a good starting point to explain a lot of things politically too, not just this episode. I think that's a potent force that some populist politicians are very good at tapping. Not people who are at the bottom rungs of society, because they were not participating in this. People who just don't have time to sit around on Reddit all day and trade, but people who felt like they deserve more, they deserve better. And to be honest, I mean, look, I mean, there's income inequality has widened in this country. It's, you have this real plutocracy in this country. Ken Griffin is like a real figure who's hated by this group. Well, Ken Griffin is kind of an easy guy to hate. The guy has like 15 houses worth more than $1 billion. He was asked to testify in this congressional committee where Roaring Kitty testified, and he had given personal political donations to most of the Republican members of the committee who were questioning him. I mean, you can, there really are two sets of rules. That it is, I think it's hard to deny that that's true. There's those for the rich and well connected, and then those for everybody else. And so that's that. I think fueled some of the resentment that led people to think, hey, weaponizing a brokerage account is pretty good. But as my book does conclude, and I want to give away the punchline, I did give away the punchline of the title, is that it wasn't a revolution, because not only did they really fail, they hurt a couple of people on Wall Street, but a lot of people on Wall Street made a lot of money doing this episode. It was a really profitable time for Wall Street. So if you're mad at Wall Street, period, then boy, you enriched a lot of people on Wall Street, including Ken Griffin, just by the sheer volume of trading that occurred. And a couple of hedge funds does not Wall Street make. Wall Street is mainly a place where transactions take place, and they're happy. They're just happy you showed up. If you showed up because you're angry, that's fine. They don't care why you showed up. They just like, it could be like the .com phenomenon where everyone thought they're a genius and going to get rich. They just love it when the masses show up and with their money and leave some of it with them.
Well, and by the way, also, I've always had this belief that, I mean, as it was unfolding with Wall Street Bets, that, and you alluded to it, right? The number of new people on Reddit, that I have to assume that there were probably some hedge funds or institutional players that were now trying to game the sentiment themselves, just like what you see as a problem on Twitter, a whole bunch of bots regurgitating a narrative to try to manipulate a certain belief, right? So it can't have been the case that the sort of evildoers, in quotes, weren't then trying to push back, making it look like they were actually retail, but in reality were just trying to manipulate retail during that phase.
It's possible that some of the, you go back and look at the boards, you don't know. I mean, people use pseudonyms on Reddit. There definitely were a lot of bots. I mean, I write about that in the book. There are a tremendous number of bots, and bot activity surged around this time, although it's always been a scourge on social media when it comes to investments. It's like the Yahoo Finance message boards times 10,000, right? In terms of the impact, it's just much more sophisticated and insidious. Whether they're human bots or bots, like actually kind of algorithms. And then if you look at some of the original posts that said, "Oh no, this is how you do it. This is how you create a gamma squeeze." Yeah, those people knew a thing or two. They weren't just some guy living in mom's basement. They knew exactly how to get the most bang for the buck. So I do suspect that there were people who got the snowball rolling at the very least. Maybe they didn't realize how big it would be, but they saw the opportunity for a short squeeze and possibly even a corner in these very heavily shorted stocks in September, October, November, and we're out there on the boards trying to egg people on. Yeah, that's something that I unfortunately have not, is beyond my ability to get to the bottom of, and the SEC maybe could have, but they didn't. But yeah, I think that's probably pretty likely. Listen, there's the amount of hate mail that I've received is off the charts. Just my email address is out there, spencer.jakab@wsj.com. It comes to me or through social media or whatever. So yeah, people really do it resent it a lot, as putting it mildly. But yeah, I think that education, I mean, clearly there's a lot for these people to learn, but I'm going to.
Well, and there's a lot for everybody to learn, in fairness. I mean,
right. I've been doing this for 30 years, and there's a lot for me to learn. So there's always things to learn, right? I don't think that that's the solution. I think that when you have like a financial executive after an episode like this kind of brought before Congress, and they say, well, what we really need is education, that is a cop-out. I'm sorry, because the level of education that even if you I was only in finance for 10 years. I've been a financial journalist for 20 years. I don't go and trade individual stocks. But if I went out and tried to do it, I don't think that I'd be particularly successful. I don't think that I would blow myself up. But I don't think that would be like if I quit to become a day trader or something like that, I don't think that I would do particularly well, and I don't think most people would. I think there's a very small percentage of people who would do well by being very active. So I think the this saying that we need more financial education, the thing that people many people have learned, and Wall Street hates this. The thing that many people have learned, especially in the last 10 or 15 years, is that it pays to be cheap and lazy. That basically having a kind of a low turnover, low cost, passive strategy is the best strategy. You will beat 85% of your friends and neighbors' portfolio performance by just putting your money in some kind of automated way into a balanced portfolio that costs very little and letting it sit. That's absolutely true. I mean, obviously, there's the 15% who will do better than you, and people overestimate their ability in all kinds of things. And hey, you have to be smart to do trading. And most people think they're smart. Most people, if you poll 1,000 people, 800 of them will think they're smarter than average. And so, trading and making money in the stock market is the ultimate kind of test of IQ, as far as I'm concerned. That's why it's so fun to write about, because you have all these professionals constantly battling, 24/7 in markets to do well, and it's a zero sum game, right? So it's kind of a real real kind of achievement to do well consistently as an investor. But I don't think that people should try. I think most people really should not be trying. I think that's the education that they need, is that you don't go out there and try to sort of jump ahead of a meme stock, and people will come up with all kinds of excuses when they're not successful as to why they weren't successful. And the way that these apps are set up, by the way, encourage that sense. They give you FOMO. It's like when you open up Robinhood. Why is it useful to see the 10 most traded stocks that day, or the 10 best performing stocks that day? Because it gives you the sense that, like, oh, I missed that. Or why is it important to have a chart of a stock showing you that if you had just gotten out a little sooner, or just gotten in a little sooner, you would have made a lot of money? That's not useful information. That's information that gives you like the near miss effect. Just like, when you go to a casino and like two cherries come up instead of three. Doesn't matter. You don't win with two cherries. But the fact that two cherries came up give you the sense, and gambling establishments understand this very, very well, that you got really, really close to winning, so you should keep trying. And that's damaging to your net worth, when you're an investor. Yeah, no, thanks for that. I do write about them. I note that. I noted the Neo episode, and there was one other episode in the fall of 2020 where he came out with a short report of a stock that was heavily held by Wall Street Bets users, and so he was already a reviled figure. And then he told people that they're the suckers at the poker table just days before the really big explosion in GameStop. So yeah, it was like he really egged them on. It was he miscalculated, because the thing about a poker table is, like, you have someone with like a ton of chips at the poker table. They don't have to be playing smart. They have a ton of chips, and he got buried, and I almost, I mean, I'm not going to go out there. I didn't get into this in the book, but it almost seems like maybe he understood human nature enough that maybe he was. How do you know he was short, right? I mean, you don't know how much money he lost on the short. I mean, like, it was like if anything, I mean, what I did speak with him for the book, and I outline all this, the ways that he specifically kind of like just lit a fuse for this. If he was smart enough, maybe he was somehow, maybe he somehow profited from it too. He didn't seem that upset. I did speak with him on some occasions after shortly after the episode. Thanks. I mean, in terms of regulations, I mean, what it's hard to go to someone who designed a really good, smooth app and say, hey, you made it too much fun to trade, or you made it too easy to trade. I think the only thing that you could do from a regulatory point of view to cool sort of this like kind of harmful retail speculation, and I don't think it's going to happen, would be to throw some sand in the gears, perhaps by having something like there are negatives to this too, and the people who want to do this are not really looking out for mom and pop. I think they just don't like Wall Street. But to have like something like a financial transactions tax, where making it at least cost something to transact, because even if it cost 50 cents or $1, you would think about it. In terms of making
By the way, I would add that's one way to also get rid of all the high frequency trading benefits, which I actually would argue that's kind of a good thing.
Yeah, exactly. I mean, it would solve some problems. The people who are really pushing, I don't think they'll ever succeed because the lobbying might of Wall Street is too strong. But I think the people who are really like the Bernie Sanderses of the world, they're pushing it for it just to stick it to Wall Street. They're not out there looking for making Wall Street less of a casino. They just want to cost Wall Street money. They don't like that milieu. They don't like that crowd. They don't get campaign donations to that crowd. In terms of making short selling more, short selling is already a very, very difficult game. You're going against, you're a short seller. Your losses are theoretically unlimited, and your gains are capped at 100%. Yeah, I mean, I think if there are very few pure short selling funds that actually have made money. So the appeal, even if you're really, really good, even like a Jim Chanos, he's made like very little money. His fund has shrunk to almost to much less than it used to be. And he's the best of the best, or considered to be the best of the best. So I think that short selling is I mean, of course, Gabe Plotkin is not a short seller. He sold stock short. Most short selling is done by people who are long, and most investors in pure bear funds or pure short selling funds do so as part of an overall long strategy. They do it, for reasons of hedging and basically smoothing out their returns. So, yeah, I mean, I think pure short selling it's like a dying art because it's just too difficult to do, and especially in this era now, it's become very difficult to do. Actually, now that interest rates are rising, I mean, just it's a technical thing, but now that interest rates are rising, it actually is a little bit easier to do short selling, not because of the effect that it's having on stocks, but because of the kind of the negative carry is not as bad. But yeah, short selling is a very tough game. I think that one possible rule, I don't think it's a particularly helpful rule, would be, I mean, requiring the sort of disclosure. So having a lower threshold for disclosure of a short position than you do for a long position. So, for example, you don't have to file an immediate report, if you have a small long position in a stock, but that threshold would be, I mean, it's typically, when you have like a crazy episode of markets, especially when you have a big drop in markets, like in '08 and stuff like that, restrictions are put in on short selling and stuff like that. So I do see that's one set of rules that I do see possibly happening, which is, further reporting requirements for short selling, which of course makes it more dangerous because, now you have a lot of this kind of activism where people are targeting short positions and trying to shake people out of their short positions by squeezing them. So it is just making it tougher to do. But, if you're just an ordinary investor buying individual stocks, what I think people don't understand is that the existence of short sellers is beneficial to you because short sellers provide a lot of liquidity in the markets, and you need somebody. So you can't just have two ways to bet on a stock. You can't just have like, I like it or I'm going to abstain. I don't have any view on it. You also have to have the ability for people to say, no, this is overvalued, this is a bubble, or there's some fishy business going on, and I'm going to actively bet against it. Without that, stock prices are less correct, and bubbles persist for a longer period of time, and then more sort of, especially the most naive and vulnerable of investors get pulled in. I mean, if Enron had gone on for another year, it would have sucked in a lot more money. People excited about this cool company that's revolutionizing energy trading and trading, electricity and bandwidth and whatever, and it was all a fraud. So that's an extreme example, but it is useful to have short selling out there. I think one other possible rule change, it might involve, instead of like reforming payment for order flow and having orders go to an auction system, that doesn't seem very workable. But yeah, some rules might come out of it. But generals are always fighting the last war too in Washington, and so I think the rules that come out of this are not going to be helpful for the next crazy thing that happens, unfortunately.
Good place to end the space. Thank everybody for joining. Spencer, really appreciate you spending the hour with us, and everybody enjoy the rest of your day if I don't see you. Thank you, Spencer.